All right, welcome everyone to this webinar on raising capital. So we've got lots of people coming in. Let me know in the chat where you're watching from. If you're watching this on the recording, that's totally fine. For those of you that are watching live, obviously I'm live. But if you're watching the recording, I might say that anyway. So yeah, we're going to cover the art of capital raising, and hopefully whatever you're currently looking to raise, whether you're looking for buying properties, buying businesses, equity deals, whatever it is, I'm going to share with you some content and it's basically a little bit about my story and about what I've learned. I've raised hundreds of millions of dollars over the years. Most of it was a really hard slog. And anyone that has raised capital will know that raising capital is generally a really hard slog. And then some of it was really, really easy. And it was only when I started to investigate what was the difference between the hard slog and the easy that I realized something very, very fundamental, which is what I'm going to share with you today. And it's not stuff that I've seen elsewhere. I mean, I've been in this industry for 15, 20 years. I haven't seen anyone else talking about this. So hopefully you'll find it interesting. Chuck any questions in the chat. I'll try and get to them. Obviously, if you're watching the recording, you can't do that. But yeah, connect with me on LinkedIn or whatever, and we'll try and do that. All right, let's crack in. I think the other really interesting point about this is, so I'm recording this now in May 2025. Obviously, people have been talking about AI for a long time. In the circles that I'm working in and sort of a lot with small business owners and big business owners, there's a lot of talk about AI and what's coming. The one thing, nobody can really predict what's going to happen in the future, but the one thing I'm absolutely certain of is that if you have money, you are always going to be in demand because it doesn't matter what's going on with AI. Entrepreneurs are always going to have ambitions that are bigger than their resources. It's kind of our inherent situation. And so if you've got money, you're always going to be in demand. The next best thing is knowing how to raise capital. And I genuinely think whatever your background is, whatever your knowledge or experience, whatever your geography is, if you learn what I'm going to share with you today and implement it, and so you learn how to raise capital, you will always be in demand because there will always be companies that want to raise money. And so to me, this is one of the most important skills that you can learn. So hopefully you'll find this useful. All right, a couple of things that I'm going to cover. I think it's really, really important to understand the investor mindset and supply and demand. So we're going to crack into that first of all. Then I'm going to talk about investor networks. I'm going to talk about why I failed to make this work for years and years, and what I did differently that now works incredibly well, not just for me, but for lots of other people, and how you can apply that as well. So those are the two things we're going to cover. Should all be wrapped up inside of an hour. And hopefully I can get to your questions as well. Now, look, there's because of the number of people on this, I'm not going to kind of be too interactive, and I know a lot of people are watching the recording. But it's always interesting to kind of know who's watching this is already an investor versus somebody that's like an entrepreneur just trying to raise money, or someone that's just interested in capital raising. Let me know in the chat if you are an investor. When I do this webinar or this seminar in public, and I occasionally do it in rooms with 50, 100, 200 people in the room, and I'll ask this question. I'll say, who is an investor? And depending on the audience, depending on what the conference is, you normally have sort of 5–10% of the room will put their hands up and say themselves that they are an investor. And then I ask the next question, which is, who has got investments? So who owns property? Who owns equities? Who owns bonds? And almost every hand in the room goes up. And what you realize is that everybody is basically, as long as you've invested in some Tesla stock or some Google stock, you are an investor. If you've bought a house, you're an investor. And I think one of the things to understand when you start raising capital is to look at a wider playing field than just those people on LinkedIn that have investor in their title. There's a lot of people out there. You know, the book The Millionaire Next Door, there's a lot of people out there with a lot of resources who potentially be interested in your project if they knew about it. So don't just be tied up by investors. The other thing that I'm always keen to understand is, what are you looking for as an investor? And this is something that definitely differentiates different investors. Just looking at the chat, you've got lots of people understanding that they're investors, own equities, own property. Great. Look, what's the thing that you're looking for in investment? And it's interesting. Generally, when you talk to different investors at different levels, they're looking for different things. Now, I always used to ask, I would be asked this question a lot, and I used to sort of give the typical answer of a small business owner of things like, well, it's all about having a good team or having product market fit. What you're going to see as we go through this presentation today is that my view on that has completely changed. And the answer that I will give you for the number one thing that I look for in an investment is completely different from anything I've ever heard anyone else say. And hopefully you'll see why it makes sense, and it might make sense for you to think slightly differently about what you look for in investments as well. For those of you that don't know me, my name is Callum Laing. If you're trying to figure out the accent, I was born in New Zealand, grew up in the UK. I've been in Asia for 20 years. I have businesses all over the world. I've taken over 100 companies public. I've raised hundreds of millions for various companies, made millions, lost millions. We have a fund today that's $100 million fund that was very easy to raise money for, and written 4 best-selling books, won a bunch of awards and other bits and pieces. And so basically, I've kind of been immersed in this space for 15 years. I'm quite happy to hold my hand up and say I was very bad at it for a long time. It wasn't enjoyable raising capital at all, until I kind of started to understand the philosophy I'm going to share with you today. So this is a live shot of the first time I tried to raise money. So I'm going to share this story because it's embarrassingly bad, but some of you might relate to it. So when I was a young entrepreneur, I was actually in Thailand, and I was trying to raise some money. I can't even remember what the project was, but I do remember the amount that I was raising. I was trying to raise 200,000 baht. Now, 200,000 baht at the time was about 7,000 US dollars. So if you want to try and understand where I was as an entrepreneur at that point, I thought $7,000 was the right amount to raise. And I'd been introduced to the owner of a property company who apparently invested in projects, and I'd managed to get a meeting with him, this Australian guy. And I remember it was the first time I pitched for money, and clearly I was doing a terrible job. He really wasn't interested at all. And I eventually said, well, come on, look, it's only 200,000 baht. And he said to me, it's only 200,000 baht. That's a lot of money when you don't have it. And closed the meeting. And I realized at that point that I had a lot to learn about raising capital, because he was right. Basically, any amount of money is a lot of money if you don't have it. And so I needed to learn. And so kind of as a young entrepreneur, I just added it to the long list of things that I needed to learn. I needed to learn how to attract clients, how to do marketing, how to do operations, how to do finance, and how to raise capital. So I kind of went and Googled it and read books on how to raise capital. And if you've done this previously, if you've done this yourself, you'll know that basically all the advice is pretty much the same. It's like, and a lot of it comes out of Silicon Valley. And the idea is basically, here's a company that's raised money, so Foursquare or Uber or Facebook. This is the pitch deck that they used. Adapt this to your company, and then go and knock on 1,000 doors. Just go and hit one investor after the other and just pitch over and over again. And things like Dragon's Den really sort of kind of endorse this idea that what it takes to get capital raised is just to have a good idea and then just keep pitching it in front of investors. And so that's what I did. And I discovered that it's horrible. It's a really horrible thing to do. Most investors are just not interested. Lot won't even take the meetings with you. Those that take the meetings, sometimes they'll just put you in front of an intern to do the pitch, and it's just a soul destroying experience, and you're just getting rejected and rejected and rejected, not really learning too much. Now, eventually I kind of got better at this. I learned a few lessons. If you've read any of my books, one of the lessons that I learned was that as uh, an entrepreneur myself, I didn't have a lot of credibility, and that was part of the reason why investors weren't investing in me. But when I put together a board of directors with some really, really big hitting names, so somebody from Google, someone from Microsoft, someone from Yahoo, I put them on my board, suddenly it was really easy to raise money. Or not really easy to raise money, but I was able to raise money at a 10 times higher valuation than I had been before I had that board. And it was just by adding the board. Nothing had changed about the business. So that was kind of one of the things that I learned, but it was still a pretty painful process. But I was becoming a better entrepreneur, and I was starting to have some success and sell some businesses and make some money myself. And I became an investor. I started to have some money in the bank, and so I started investing. And I realized that the things that make you a good entrepreneur don't necessarily make you a good investor. And so it's very true that the more money you have, the more opportunities you have to lose it. So I invested in projects that I liked, and that faith that we have as entrepreneurs that everything's going to work out in the end is great for being an entrepreneur. It's not very good as an investor because oftentimes things don't work out. And so I lost a lot of money, learned a lot of lessons. Now, as time kind of went on, got a little bit older, got a little bit wiser, not much wiser. Um, I moved to Singapore and started working with Jeremy Harbour, who's the gentleman on the left there. And one of the things that we were doing is we were raising money. We had property deals, we had bond deals, we were taking companies public. And so we decided that what we would do is we would build a network of investors, because we're constantly going to be raising capital. And if you have a network of investors around you, then you can just keep going back to them with new deals, and life becomes much easier. And so we used to run these events, and they were very, very popular. We would invite investors and business owners to our office in Singapore and give them wine and build this network. The problem was it just didn't really work. Like, the events were great, but we could never maintain the relationship with that community. We could never build the community of investors, which was odd because it's something that I've kind of done all throughout my career, is build communities very successfully. And yet I couldn't do it with this investor group, which was really annoying because we wanted to keep going out and raising money, but we had to keep finding new people over and over again. Um, but through sort of the journey that we did, we were raising money for real estate. We'd raised money for IPOs, and we had some successes and we had some failures. But generally, it involved kind of going back to this process of pitching to strangers. And one of the things I thought when we moved into the public markets was that the advice around raising capital would become a lot more sophisticated, because at angel and startup level, it's basically have a nice pitch deck, go and knock on 1,000 doors. I thought, well, surely big publicly listed companies don't do that. Actually, they do. It's exactly the same model. It just costs more. So you end up paying to get your message in front of investors, and you still get rejected just as much as you do as startups. So it's not much more sophisticated at all. Now, around 2019, I was approached by there was some gentlemen that had been the founders of two networks that I was very impressed with. One is Young Professional Organization, which has about 30,000 members worldwide. And the other is EO, Entrepreneur Organization, which has around 25,000 members worldwide. Now, these are two very, very successful networks. You might be familiar with them. They're pretty much global. People that are in them love them. And the founders of those had come together, and they'd decided that they were going to try and build what myself and Jeremy were building, which was this network of investors. And so they were going to put together a platform where you could connect investors with people that wanted to raise money. And at that point, I had been trying to do that for about 3 or 4 years and absolutely failing. And so when they approached me and said, "Hey, would you help us launch this in Asia?" I thought, well, fantastic. Yeah, of course, because now I can learn, if anyone can sort this problem out, these guys can do it. They know how to build this network. So I became an ambassador for them. I helped them promote it in Asia. Eventually, the platform was ready. I went onto the platform. Um, and it was just a bit meh. It still exists today, so I shouldn't criticize it too much. But um, yeah, it's kind of they were trying to match up investors and small business owners, and you had sort of oil and gas companies, and you had biotech startups, and you had private equity investors, and you had angel investors, and it was all just a bit of a mishmash. And as an investor, I went in, I couldn't find deals that were particularly interesting to me, and so I didn't go back. And there's somebody raising capital, I'd went on and I couldn't find the investors I was looking for, and so I never went back, and it just didn't really work. And I looked at a few other networks that were trying it as well. They were having the same problems that we were having. So everyone is having the same problem. Everyone wants to solve this problem. There's people out there with money that want good returns on money, and there's people that have great projects that need funding. So everyone's trying to figure out this problem, but it just wasn't really gelling for anyone. Now, at the same time, we were taking companies public. Sometimes I was sitting on the board. Sometimes I was an executive in those companies. This was one of the companies that we took public. So I mentioned sort of a public company. I thought it would be a little bit more sophisticated. It's really not. This was a roadshow. So public companies do these roadshows. In this particular one, I think it was 70 meetings in 7 cities in 5 countries in 5 days or something crazy. So basically, you're just doing back-to-back meetings, jumping on an airplane, going to a different city, back-to-back meetings. And you kind of get to a point where you've done the same pitch over and over again so many times that you can just do it with your eyes shut. And in fact, your mouth just keeps moving doing the pitch while your brain is thinking about other things because you're so bored of your own pitch. And I remember in this particular this photo, I think this was in Frankfurt. I was speaking to about 200 people. And while I was pitching about the company and what we were doing, I was kind of thinking to myself, something's just not adding up here, right? We've got a great company. There's investors out there that want to do this, and it's just not working. It's really, really hard work. And I started thinking about who was investing in the company. And actually, despite the fact we were a public company and quite a successful one, we were profitable, we were growing. I actually knew the majority of the investors, and I knew them by name. I knew them by their numbers. We would text, we would chat. And there was actually only a relatively small number of investors that were kind of retail investors that I didn't really know that were trading our stock. And I started to think also about my own investments and why was I investing in some projects and not other projects? And so this was sort of where I started to have a bit of an awakening on the way things work. So do you want to have a little stop there? And I want you to kind of go through this thought exercise because this is kind of an important piece to consider. If you were to meet somebody, so this is sort of really about the importance of your network and the opportunities around you. So what I want you to do is imagine that you meet somebody today or on this call or in a meeting, and they've got this really exciting business opportunity. And they say to you, look, it seems like you're interested in this. I'd like to work with you. I like your background. I like your energy. I think we could work on this project together, and you're really excited about this because this is something you believe in. But they want to see how resourceful you are. And so they say to you, okay, you can be my partner on this project, but I want to see how resourceful you are. So in the next 24 hours, see how many expressions of interest you can get from investors. So what I want you to do is imagine that you get off this webinar and you immediately go through your phone list and you start reaching out to people and say, hey, I've got this interesting business opportunity. I'm not looking for hard cash. I just want an expression of interest. I'm going into business with this person. Would you be interested in backing it? And just have a think, like, who do you know in your network that might be able to back you in this project? Maybe you've got a nice father-in-law that would write a check for $50,000, or maybe you've got someone you play golf with that would write you a check for $5,000. So just have a think through your network. And if you were to come to them with this amazing business opportunity, can't tell them what it is, would they back you? Do they believe in you enough? Do they trust you enough that they would be willing to write an expression of interest? So just have a think about that. If you've got a number in mind, stick it in the chat. I've done this exercise many times, and you do kind of get a range of people. Some people, yeah, might only be able to raise $5,000. Some people might even be less than that. Other people, they've kind of built quite a good reputation with their network. They've got some wealthier people in their network, and they could probably raise a few $100,000, in some cases even more. So have a think yourself. Write down a number. You can put it in the chat or just write it down in front of you. How much money do you think you could raise? And basically, this is an indication of how resourceful you could be. Okay, so one of the people, somebody has said $1,000. That's fine. Like it's if you've never done this before, that might be a realistic number. And by the way, that's not a bad sum to just be able to go and pull $1,000 out of the air based on you having a conversation with someone is pretty impressive. So have a think about that. What you think you'd be able to raise. Okay, somebody's gone lower than that. Um, uh, but now I want you to redo this exercise. But I want you to do this exercise, but rather than just meeting someone, you're going to meet Richard Branson. So imagine that we're doing this call. Richard Branson's on the call. He connects with you. He says, look, really like your energy, really like your background, quite happy to bring you in as one of the partners in this project on the ground floor. I want to see how resourceful you are. Now go out to your network and basically see how much you can get in terms of expressions of interest. So now you're going out to your network, you're saying, hey, I've got this opportunity with Richard Branson. I can be a partner in this. Would you like to be an investor on the ground level for this deal? How much do you think you could raise now if you were able to leverage off the brand of Richard Branson? By the way, I used to do this exercise with Elon Musk, and and then his sort of star faded a little bit, and people started losing money on the deal. But Richard Branson still, yeah, this is an entrepreneur that has built 8 different industries at over $1 billion. So some people are saying that they don't know. But look, what tends to happen is if you've got people in your network that are investors, basically most investors, if they had the opportunity to get in to a startup deal with Richard Branson, would take that because they know that Richard Branson isn't going to start something unless he can grow it to $1 billion market cap. He's done it 8 different times in 8 different industries. He's a pretty smart cookie. He's got a lot of resources behind him and a lot of success behind him. And if he's partnering with you and they already trust you, then that makes the deal pretty attractive for a lot of people. And so generally what happens is that most people are able to raise about 10 times as much money by leveraging off a brand that people trust, whether that's Larry Ellison or Richard Branson or whatever that might be. And so well, this is kind of interesting is first of all, it's around making sure that you have the people in your network that have the resources. So you might have people in your network that wouldn't be able to invest regardless of the opportunity. And that's fine as well. But if you want to get into this space of capital raising, you need to start getting very deliberate about putting people in your network that do have the capacity to invest when you have these opportunities. And then the key thing to understand is really noticing that actually the money is there. There's no shortage of money out there if people believe that they're going to get a return for it, if they trust. And this is the bit that's really kind of missing with most content around raising capital. It kind of jumps over this bit of trust. And the reality is that investors don't put money in unless they trust you. Uh, and so this is the key element. The deals that I've done where it's been really easy to raise money is because it was the right deal, the right person at the right time. Now, most of us, when we go out and try and raise money, and all those times I was trying to raise money in the past, I had my business, and then I was going and trying to find investors. I was knocking on these doors. I was hoping that I had the right deal. I was hoping that I found the right person. But even if you have the right deal in front of the right person, if they haven't got the money available at that time, it's the wrong time. So if everything has to line up with the right person, the right deal, and the right time, which is why it always feels so much hard work to go and try and raise capital. So that was kind of one of those things when I was standing on stage, I was starting to go, okay, well, this is why I invest in people's deals. It's because I trust the person, I trust the deal, and I've got capital at that time. And this is why people have invested in my deals. It's because it was a deal that they were looking for, it was at the right time, and we already had that trusted relationship. And so I started to think about it in terms of the bigger market. And I think this is really a useful thing to do, and an area that for all that the financial markets are covered, very few people talk about this. And even to the point where I've had lunch with the chief economist of one of the biggest private wealth banks in the world, and I shared this idea with him. And he said, in 30 years of looking at the economy and looking at what makes stocks go up and down, he'd never seen anyone articulate this idea like this, which is a little bit disturbing, but hopefully you'll see where the value is. So if you're as old and wise as I am, you remember back in the kind of the heyday for the public markets was in the 70s and the 80s. And when a company went public, it was a really big deal. It kind of made the national news. And what would happen is there was no online trading in those days. You used to have to phone up your broker. You'd try and get through to your broker, and then you would tell that broker to try and get some of this stock in this new listing. And then you would hope that they would be able to get hold of some stock. So that was the idea. But the reality was that in the 70s and the 80s, there wasn't actually that much to invest in. There weren't that many companies that went public. There was no angel investing outside of a very small part of Silicon Valley. There was no ETFs, like ETFs were existed, but they were very, very small. And so as if you were sitting on money in the 70s and 80s, you were genuinely sitting there with your checkbook waiting for good ideas to come along. Today, that situation is completely different. Today, there are so many opportunities out there. The biggest companies in the world on the S&P 500, the top 8 companies in the world, yeah, they're still growing at 20-25%. They're sitting on 100 billion in dry capital. Everything else is competing with that. So you've got all those big companies in the capital markets where there's tons of liquidity. And then you've got startups everywhere. Every man, woman, and child seems to be raising money for a startup. You've got ETFs, which are exchange traded funds, which what sensible investors do, which say I'm just going to play the averages. You've got bonds, you've got all these different options, plus all sorts of clever, sophisticated investment tools as well. And so the average investor now is absolutely inundated with ideas. So another company going public or another company trying to raise money really has to do something very, very special to cut through the noise. And that's what I was realizing when I was on stage in front of those companies, was that I wasn't cutting through the noise. What the other thing I really noticed was when I talked to investors and actually kind of sat down with them, their biggest concern was if we were taking a company public, that everyone on the inside was going to be selling stock. And this is a really, really fundamental idea, because this is what ultimately ended up shaping the way we build our companies now. So if you Google IPO, so initial public offering, which sort of is the entrepreneurial dream, is to build your company and take it public, it's all written in terms of this exit strategy. So it's all written in terms of the idea that an entrepreneur builds a business and then they exit by going public. Now, what that means is that they go public and then they sell their stock into the market. Now, if you think about the origins of the stock market, which was in Holland 400 years ago, it was about shareholders sharing risk in this boat journey over to the Far East. And then in return, they got a share of the reward. So that was kind of the idea behind being a shareholder. Today, what happens is it's kind of been bastardized a little bit. And now what happens is you've got the founder wants to take money off the table, so they sell their stock. You've got staff that have been underpaid for years, but given stock options, so they want to sell their stock. You've got early investors, angel investors, venture capitalists, private equity. They want to go public so that they can get their money off the table and invest it into other deals. You've got the investment banks that take stock and they want to sell it as well. So basically what happens is companies go public and everyone on the inside starts selling their stock. Now, at the same time, on the outside, investors are completely overwhelmed with options. It's not like we're starved of deals anymore. And so we see yet another company go public. We know that those founders are all going to be selling their stock. There's just no point in buying it. And so what happens is the share price goes down. In fact, over the last 30 years, nearly 60% of all public listings have gone backwards. So they're shareholder destroying, destructive of shareholder value. And you can see it's actually getting worse. So as we've gone in since 2020, the numbers are actually getting worse in terms of how companies are performing. And so, of course, this becomes a self-fulfilling cycle. Like as an investor, I don't want to buy a brand new public listing because I know they're going to sell stock, and because I don't buy it, then there's no buyers, and then there's nobody to pick up the stock, and so the share price goes down, and because the share price goes down, more people sell, and so it kind of gets into this spiral. So public markets have become quite a depressing place for businesses to go. So what we did, we were starting to have this realization. And by the way, we've taken 100 companies public, so we really understood that this wasn't working, and it wasn't. We were taking companies public that were profitable, they were cash generating, they were generating dividends. It was everything. We were ticking all of the boxes, and yet we were still having this issue. And what we realized was the most important thing in any investment is the behavior of the other shareholders. So if you buy, whether you invest in a startup company or you invest in Tesla, the most important thing is what the other shareholders do. If the other shareholders start selling, then you're going to have too much sell pressure and the price will go down. If they start buying, then there's more demand than supply and the share price goes up. That's the fundamentals of investment. And yet what most people look at when they think about, shall I invest in the stock, is not what are the other investors going to do? It's what's the management team doing? What's the technology, or what's the moat, or what's the macroeconomic environment? Now, all of those things can have an impact on the behavior of other shareholders, but the most important thing is how those shareholders behave. If everybody stopped selling Google stock today, or Alphabet stock today, the share price would spike up enormously, because it would only take one extra buyer. And what happens is the automated systems would try and fill that position. Nobody's selling, so it would move up to another price. Nobody's selling, it would move up to another price. Nobody's selling. The way to think about this in a small environment is if you think about an angel investment. So say a founder comes to you and says, hey, I've got this great idea for a business, and I want to raise 100,000. And you say, okay, well, I'll be that partner. I'll partner with you. But what I want to understand is, what are you going to do with your remaining stock? Because if you keep selling that stock to other people, that's going to force the price down. If you hold on to that stock for the next 5 years, sorry, then I know that the value of my stock is likely to go up, or at least it will stay equilibrium. So actually, the most important thing when you're thinking about investment is understanding what the other investors are going to be doing with their choice. So my friend Daniel Priestley, who's the author of Entrepreneur Revolution, he's founder of Dent and stuff, he actually talked about this in Entrepreneur Revolution. He talked about it from the point of view from entrepreneurs rather than investors, but it kind of plays out. If you think about in the agricultural age, the people that made the money were the people that owned the land. In the industrial age, it was the people that owned the factories that made all the money. And in the digital age, it's the people that can create demand. So it's now, in today's world, it's very, very easy to create supply. So if you think about my world, it's very, very easy for me to get stock that I can supply to investors. It's much, much harder to create demand for that stock. So what you notice is that the top entrepreneurs today are the ones that are very, very good at creating demand first. So if you look at when Elon Musk launched the Cybertruck, he raised 200 million by getting people to put down a $1,000 deposit if they were interested in the Cybertruck. So years before he actually built it, he had got all the cash he needed in order to build it from people putting down deposits. Mr. Beast spent years building up his channel, created tons of goodwill, amazing audience, which meant that when he launched Mr. Burger, you just turn the light on, please. When he turned on, when he created Mr. Beast Burgers, it was the fastest selling burger chain of all time. And when he launched his chocolate brand, he sold $10 million worth of chocolate in the first 2 months because he had the audience, he had the demand already. Ryan Reynolds, who is just seems to be absolutely on fire at the moment. Everything he touches turns to gold. Again, has been able to use his audience and take the investments that he's made and elevate them through creating demand and creating brilliant entertainment around those businesses. So the real value here is understanding that you've got to start with the demand side, not the supply side. The supply side is the easy bit. The demand side is the bit where the real value lies. So what's interesting is entrepreneurs kind of understand this. If you look at the sort of traditional message that's come out of Silicon Valley, this is quite a useful message, which is, don't try and build a product and invest tons and tons of money building a product and then go out and see whether the market wants it. Find out whether the market wants it first, build a minimal viable product. And if the market wants it, then you can invest more money into building it. And so most entrepreneurs know this now. Most entrepreneurs try and get forward orders and understand that you wouldn't do that. And yet when it comes to fundraising, entrepreneurs go completely the opposite way. We spend a year or 2 years building this business, and then we go and try and sell equity in the business, which is a product that we've invested 2 years in, and we've got no idea whether investors actually want that product. We've got no relationship with investors. We've never found out what investors want or what are they looking for. And so we have to go through this process of knocking on doors. And oftentimes we're just talking to completely the wrong investors in the first place. And so really the trick here, if you understand that it's all about demand and not about supply, the trick here is to play the reverse Uno card, is to start with the investors and work backwards. Now, I know this isn't what you want to hear. If you've got a company already and you're trying to raise money and you need to raise money because you've got to pay salaries at the end of the month, this isn't what you want to hear, but it's still worth understanding because it should shape the way that you approach investors. So this is what we eventually did, and it took us way too long to work this out, but eventually we stopped trying to sell pre-IPO stock to our clients, and we said, look, we can see the numbers. We can see the fact that the economy is changing, that public markets, apart from a very small number of companies, aren't giving great returns to investors. So let's go back to basics. What do you want as an investor? What are you looking for? And when we talk to our investors, who mostly were high net worth individuals, family offices, small institutions, what they said to us was, okay, we want less volatility. So the problem with small cap and micro cap stocks is that they're very volatile because there's not much liquidity, which means if somebody buys, the share price spikes. If somebody sells, the share price plummets. And people always say they don't mind volatility. What they mean is they don't mind volatility when it goes up. They don't like volatility when it goes down. So our investors said we don't want as much volatility. Really, we want consistency. Like we're quite happy to support small business, but the capital markets are too risky right now. We're looking for risk off. We're looking for something more stable. Now, the problem is our core business was around taking companies public, and this solved a real problem for small business. And those were our clients. Those are the problem we were trying to solve. So now we had a problem because we'd designed our business around solving a problem for small businesses, taking them public. But we had to solve this problem for investors, and investors were saying they wanted a different product. And so we had to design a product that met the needs of the investors and then worked back to solve the problem that we were trying to solve for our members. And so it took a while, but eventually what we ended up doing was we created a bond. So a bond is a loan note, and we basically went to those investors and said, okay, you don't want risk. We will pay you, we'll borrow money from you for 5 years, and we'll pay you 15% on that. And then we will use that money to support our own public companies. And we're not going to worry about trying to sell stock on the market. We're going to basically operate what we call a constrained stock model. Now, when we did that, when we basically went to our investors and said, you said you wanted this, so this is what we've offered you, they said, great. So we did a $10 million raise, and we were massively oversubscribed. So it sold out straight away. And in fact, what happened was our investors said, we want more of that. In fact, can you do a regulated fund so that we can bring in our family offices, so that we can put more money into this project? And so what we ended up doing was hiring a third-party fund manager and doing a Ministry of Singapore regulated fund, which was $100 million fund. And even before we had launched it, it was 80% subscribed. So many people wanted to get access to that. And all that had changed was we were offering them what they wanted rather than what we were trying to sell. And we just had to do some things on the back end to make sure it fit into what we were doing. Now, most companies that go out, or most individuals that go out trying to raise capital, they don't do that. And we hadn't done it for years. We just said, look, this is what we've got, take it or leave it. And most people just left it. So absolute sort of fundamental idea here is start with what the investors want and try and shape your product to fit what they want. And so we now got to the point where we have a wait list of people that are waiting to invest in our products when we have them, which is a very, very different situation from us going and knocking on lots of doors. So key takeaways from this section that hopefully give you some ideas is it all comes down to investor supply and demand. But you've got to really start with what the investors want. And I'm going to talk about niching down because investors are very different. That's the next section. But let me know in the chat, does that all make sense to you? Does it understand why investors would be much more open to this? And by the way, look, there are, when we created this product for investors, what happened was other investors came back to us and said, well, we don't want that stable product. Actually, we want the upside. And so we ended up having basically two products and said, this is what you can do. You can invest in this, which is the bond. It just pays 15%. You get all your money back in 5 years. or you can have this other product, which is an equity portfolio product, but it has upside and it has downside risk. So you might want to put 80% into the bond and 20% into the equity product. And so it completely changes the game, but you can only start to get to that point by meeting with the investors and talking to them and trying to find out what they actually want. Caroline says it makes sense. Great, good to hear. Circle says, do you think the CSM model worked because you're an aggregator of those companies? No, it actually doesn't matter. Like the individual companies matter less than understanding what investors want. And because there are investors out there, whatever product you've got, whatever business you've got, there will be some investor that sees value in it. The challenge is, the worst way to find it is when you need money and you're just going and knocking on doors. It's much better to start with the investor and work backwards. So let's look at investor networks, because this was the bit that really kind of threw me for a long time, because I wrote a book 10 years ago called Progressive Partnerships, which was all about how you build networks. And I built many, many successful networks and communities over the years. I should have been able to build an investor network. It really frustrated me that it wasn't working. And actually, the best description of this that I saw is one of those really annoying LinkedIn posts that I've seen being used for all sorts of things, but it's kind of it's a very applicable for those people wanting to raise cash. So you may have seen this example before, but basically the story is that a professor, a fictional professor in a school, has 500 balloons, and he has the name of each child in the school written on those balloons. They blow them all up, they put them in the hallway, and then they say to the kids, right, your job is to find your balloon with your name on it. And so 500 kids go tearing into the hallway, and balloons go everywhere, and balloons are popping, and kids are crying, and there's all total chaos, as you would imagine. And nobody can find their balloon. It's just chaos. And so what happens is the professor runs back the experiment, and this time what he does, exactly the same thing, 500 balloons, all got the kid's name on it, but this time he says to the kids, find the first balloon you've got and then go and get the owner. So you find a balloon with a name on, and then you ask your friends until you find out who belongs to that balloon. And at the end of 5 minutes, everybody has got their balloon, because it's very, very easy to do it that way. Now that analogy gets used for all sorts of things, from finding love to selling B2B software as a service services, but it's actually a great analogy for thinking about raising capital, which is, the chances of trying to find an investor that's ready and willing and trusts you enough to invest in your deal is very, very remote. But starting with the investor and then trying to find a deal that they would like to invest in is much, much easier. And so this has sort of started to shape the way I thought about networks and what was going on. And what I realized was why my network wasn't working. So part of the problem why investor networks don't work, and they didn't work for Deal Gateway, and they hadn't worked for me, and they hadn't worked for other people that I saw, is that the definition of investor is so broad. So if you have spent $200 on an NFT, you are an NFT investor. You're a crypto investor. If you're the head of a $7 billion hedge fund, you are an investor. If you're a football celebrity that buys property in Dubai, you are an investor. If you run a hedge fund, if you run a family office, you are an investor. But those types of people have absolutely nothing else in common. And so what happens is, a lot of us, when we go out looking to raise money, we say, hey, we want to meet an investor. And what happens is we get introduced to investors, or we find investors, we connect with investors. They're completely the wrong investor. And so we end up wasting time pitching deals to people that would never invest in us anyway, because investors know their circle of influence. They know their areas A hedge fund manager is never going to go and invest in an NFT. A fund family office is never going to invest in a high risk startup. So people have different risk profiles. They have areas that they'll invest in, areas that they won't invest in. Most of us, when we're looking to raise capital, we don't know enough about investors. And so what happens is we just end up talking to anyone and blurting out our pitch and not asking them what they invest in, because we haven't got time. We've got to knock on 1,000 doors. And so we just spam them with our pitch, and that's why we get so many rejections. Now, what I realized was that was why the investor network wasn't working, because I had people in there that wanted to do only real estate deals. I had people in there that would only ever buy the S&P 500. I had people in there that were only interested in angel investing in biotech. And they had nothing in common. And so they ended up repelling each other because there was no commonality. What does work is networks of networks. So what happens is the crypto investors all come together to talk about crypto. The real estate investors all come together to talk about real estate. The hedge fund managers all get together and talk about killing poor people, or whatever it is hedge fund managers do. But they all have their own little niches. They love meeting with everyone else. I've got a friend of mine, Max Nee, here in Singapore. He brings together family offices once a quarter. Investors love meeting other investors like them because they all want to know what those other investors are investing in, but they've got no interest in what a completely different type of investor is investing in. So that was like a big sort of eye-opening for us. And ultimately, I decided to build a network because one of the companies that I own is the Veblen Director Program. And the Veblen Director Program helps women, minorities, first timers to get their first board seats, and then to help small businesses grow. And one of the things small businesses need to grow is capital. And when they're looking for capital, they go to their board of directors and say, hey, we need some help raising capital. And so those Veblen members were coming to me saying, how do we raise capital? And so what I did was I started to put together all of my ideas and all of my content around how to raise capital and build this community. And what I said to our members was, what you need to do is start building networks of investors, but specific to what you're interested in. So if you're just interested in biotech, then put together a group of investors in biotech. They'll love to, they're not interested in you. They want to meet other biotech investors. If you're just interested in commercial real estate in London, just put together investors that are in that space. They will come to that networking event because they want to know what are the latest deals and what's happening in that space. And networks of networks work. And what's really frustrating is I wrote about this 10 years ago in Progressive Partnerships and then forgot. And so when it came back, I was like, right, that does make sense. So look, what I've done with the GILD community is, so GILD stands for Global Investment Leaders Directive, and it's based around these 5 C's. And I've kind of gone over the context for you today so that you understand sort of the investment landscape and how it's changed. What I also cover in that program is around the content. So what are the methodologies that do work? What is the content? How do you present the data to the right investors? How do you build those connections? How do you build those communities so that you can become the go-to person for all the deals in biotech in Singapore, or women investing in Sydney, or whatever it might be? How do you construct deals? So even if it's not your own deal, but if you're going to put together 2 people, so somebody's looking to raise capital in this space, somebody's looking to invest in this space, you can introduce those people and you can put together an introducers deal. You can make 10, 15% on that deal just from making that connection, which can be super, super lucrative. And then the 5th C is continue, which is this idea of building long-term relationships. And one of the things that I found most frustrating about the finance world was it's so transactional. This whole idea of knocking and pitching, nobody actually spends time to learn what investors need. Whereas if you actually start with the investor, you might not be able to deliver. They might not be interested in your product today, but if you understand what they need and you help them to get what they need, they can be a useful investor in your network for decades to come, which ultimately gets, again, to that point where now you can just pick up the phone to them and say, hey, I've got this opportunity. Are you interested? And life gets much, much easier. And a great example of this is actually taken from the court record. So you may remember when Elon Musk, he bought Twitter, and then the whole market for tech collapsed, and he tried to get out of that deal, and he got taken to court by Twitter to finish to live up to his deal. And what was in the court records was this screenshot of a message that that Elon had sent to Larry Ellison, who's the head of Oracle, and a friend of his, and said, look, any interest in participating in the Twitter deal? Larry says, yes, of course. Elon says, roughly what dollar size? Not holding you to anything. Larry says, $1 billion or whatever you recommend. And Elon recommends 2 billion or maybe more. And so that deal happened. Larry Ellison basically put a couple of $1 billion that enabled Elon to go and buy Twitter. There was no pitch deck, there was no financial modeling, there was none of that stuff done. It was all done, right person, right deal, right time, but the trust was already there. And what I realized, not at this level, but what I realized was that all the deals that I was doing were all the same. They were all happening because people I trusted reached out to me and said, hey, I've just invested in this company. There's still an allocation left. Would you be interested in doing it? It kind of fits with what you're doing. And if I knew them and I trusted them, there's people in my inner circle, people like Jeremy, my business partner, if he says, stick 100 grand into a deal, I'll stick 100 grand into a deal and then ask him later what it is. There's other people in my network that if they say, hey, I think you should stick 100 grand into this deal, at least I'll look at it. I'll do due diligence. I'll decide whether it's something that I want. And then you've got the people that just spam you on the outside and reach out to me on LinkedIn and say, hey, let me send you my handy 300-page business plan. Will you invest in my company? Or cold email me a pitch deck and say, and I'm never going to look at that content. It all comes down to trusted partners. And this was all kind of going through my head when I was standing on stage in front of these 200 people in Frankfurt. And I'm thinking, what am I doing here? Like, none of the deals that I've personally invested in, I've never sat there and gone, oh, this speaker on stage is so engaging that I'm going to write them a check. It doesn't work like that. Now, I'm not saying that there is no value in what we were doing. This was a great way to start relationships with people. It was a great way to get an idea in front of people. But what I shouldn't have been pitching them as investors. I should have been pitching them as build a relationship with us. Let me help you get to what you want to do as an investor. And then maybe some of them would have been right. And so it was kind of a really big epiphany for us. It ultimately changed everything that we did at MBH. So yeah, let me know if all of that kind of makes sense. Let me know if that works for you in terms of understanding why investor networks don't work and why niche networks do work. Don't get put off by this $99. Let me just tell you about the GILD network. So I set this network up to help people that want to raise capital. So there's a bunch of content in there, but more importantly, it's a community of people that all want to learn how to raise capital, and more importantly, they want to build their own networks around whatever their special interest is. So whatever is their company or their industry or whatever they're going to do. So it's normally $99 a month to be a part of that community. Right now, I've taken the paywall off. So if you're watching this live or if you're watching the recording, if you go to guildmembers.com, see, that's the wrong link. If you go to guildmembers.com, you can get in for free because the paywall is down. Once you're in, there won't be any charges to that. You'll get access to all of the content. And there's also a super supportive community. So all of the 5 C's that I talked about, the community is very active. So a lot of people are sharing. and the group has built some amazing networks. Just yeah, this has only been around 6 months. We've got about 600 members in there now. It's been around 6 months, but people have created incredible networks of investors already. So this is David, one of our early members. Since starting with GILD and simply following the instructions and diving in deep head first, I've had 2 separate investment banker groups pitch their own funds to me. So Danny says, like, I never expected ever to have these type of city investors pitching me. Typically, I was hunting and mostly failing trying to connect with them. So it's really interesting. When you build your own investor community, people start pitching you as to why they should be in it. And that's kind of what you want to do. You want to move away from being the one trying to sell it. Tons and tons of testimonies from people that have got great connections out of it. A lot of them have gone on and built their own networking events. So David has built a group in Vancouver. Victor has built a group of IT investors in Madrid. Vaclav, I'm not quite sure where Vaclav is Eastern Europe, I think. So he's built an event. Stephen O'Mara and Justin have built a group for directors in Dublin. Andreas actually does a golfing event for investors in Colombia. Mark has done IT directors here in Singapore. So they're all taken the content of Guild members and built these incredible networks around them. All of that is free. It's all in there. She, can you just have a look? Circle is saying the page is down for maintenance. If it is down, it should be straight back up soon. It's the yeah, I think it's HTTPS rather than HTTP Guild members. But yeah, look, get involved, join that community if raising capital is something that you're interested in. There's tons of content on there, really supportive community. And look, fundraising is a much more fun thing to do as a community. Yeah, that community is super supportive. So do that. I'm in that community all the time. So if you have any questions, just reach out to me there as well. Look, I'm very transparent about this. If you can build yourself a network of investors around whatever topic you are, that's going to be valuable to me because I've got lots of deals. I've got a very wide network. If I can connect people to you, maybe you and I can do deals and we can take a slice of the action on the way through. Again, you don't need to take big slices of action for it to add up very quickly. And there are people in the community making hundreds of thousands of dollars from just connecting people to deals. So hopefully that will be you soon. If you are trying to raise money for a company, I hope some of what I've shared today will help you with that. And yeah, join Guild, and I look forward to seeing you there and hoping to raise some money with you. So thanks very much for attending, and see you in Guild members. Cheers, everyone.